Operating in Florida's insurance market is not business as usual. It's navigating a full-blown crisis. The state generates just 9% of homeowner claims, yet it is home to a staggering 79% of all lawsuits. This is more than litigation. It is a massive wealth transfer. But where does the money actually go? Over 10 years, 71% of $51 billion paid by insurers went to attorneys, not to the actual homeowners. We will dissect this perfect storm of costs and litigation, then show how insurers can protect their capital. So how did conditions get this bad? The story begins with the one thing Florida is famous for: the weather. Florida is hit by more hurricanes than any other state. This is not a rare event. It is a constant, recurring risk. Between 2020 and 2022 alone, the state saw $15 billion disasters, costing up to $200 billion. Severe weather, high reinsurance, and rising repair costs create immense pressure before a single lawsuit is filed. In response to this extreme risk, many national insurance carriers are now pulling out of the state entirely. This exodus forces homeowners into the state's insurer of last resort, causing its policy count to surge. The high costs from storm damage create fertile ground for litigation abuse, turning a natural crisis into a legal one. But this problem is not limited to disputes. A significant portion of the financial drain is outright fraud. While external pressures mount, what about threats from within? A hidden mechanism is draining insurers' capital. Many Florida insurers are part of complex structures, paying affiliated companies for services like claims processing. Audits show these fees can be excessively high, systematically extracting capital and leaving the insurer vulnerable. The hidden threat is the company's own structure, designed to pull money out before policyholders can be paid. What does this perfect storm mean for the average Floridian? They face some of the highest insurance costs in the nation. In 2022, the average Florida home policy was projected at over $4,000, nearly triple the U.S. average. These high premiums are not leading to high profits. For many insurers, the financial reality is the opposite. Mounting losses from storms, claims, and lawsuits have led to a wave of insolvencies among Florida-based insurers. Insurers are trapped between huge, unpredictable payouts and a hostile legal environment, threatening their survival. Florida's legislature recognized the crisis and passed major legal reforms to curb frivolous lawsuits and control fees. There are early signs of change, with personal insurance litigation falling nearly 25%. But is it enough? Even with fewer lawsuits, the underlying problem of fraud persists. 1 in 10 no-fault claims is fraudulent. Beyond that, 1 in 3 claims is believed to be exaggerated or overbilled, creating a constant drain on funds. With so many uncontrollable costs, what can an insurer actually control? The answer is in managing cash flow. Recall that 79% of lawsuits happen here. This extreme cost makes cash flow fragile. Uncollected debt becomes a threat. In a market of wild payouts, maximizing predictable income is paramount. Collection services become a strategic tool. This is about more than recovering premiums. It's about identifying fraudulent patterns and securing cash flow. Effective collections offer early warnings and ensure capital reserves are strong before the next storm hits. The Florida insurance market is a high-wire act. Insurers face unique challenges from weather, courts, and internal structures. In this environment, optimizing every financial process is key. Specialized collections add a layer of financial stability. For risk managers and financial officers, this is not about chasing debt. It is about reinforcing your company's foundation. Do not wait for the next crisis to expose a weakness. Fortify your cash flow and protect your balance sheet today.